Well, welcome everyone to this week's speaker series. I'm happy to be joined today by Tom Harvey from Aberdeen. Tom, how are you today?
I am doing great. Happy to join everyone this afternoon.
Excellent, thank you. So Tom, you are representing the North American Smaller Companies Fund, and I definitely want you to first give an overview of the fund. What's its purpose? What are you benchmarking? When you say North America, how outside of the United States you're involved in? Let's just do a quick 30,000 foot view of the fund itself and the strategy.
Yeah, sure. Happy to do that. And so this is a fund that uses the Russell 2000. When we think about kind of an index, a universe, what are we trying to represent? We do aim to be dedicated small cap. And I think it's one certainly area of the world today that some managers will let themselves run up the market cap spectrum. And at times this leads into perhaps overlapping exposures that a client might get with maybe other investment management managers they have, which is maybe unintended. So we do aim to be small cap. Now, really what that means is we're taking a look at the weighted average market cap of this fund versus the weighted average market cap of the Russell 2000. With some context here, that figures a little bit north of 2 billion weighted average market cap for the index. We're kind of aiming to be in that same neighborhood. It's a fund that is fairly concentrated, though. So while the Russell 2000 is the index that we use, that is a core index. It doesn't necessarily weight in any different ways, kind of the value versus growth argument. We happen to manage the same way, where we don't have a top-down view of picking up one of those exposures. But we tend to hold about 50 stocks. And so we look very different from the index, given that there's about 2,000 companies to choose from. This is a fund that focuses very much on quality. And so what that means is the first thing we're looking for when we meet with companies, when we do our company research, what's the industry that this business is in? Where do they fit within that industry? How strong is their competitive positioning? It's some of the things that I suppose you could look at without going to see a company. What's its balance sheet look like and its cash flows? All these different financial metrics that might give you some idea. Let's call it the health of a business. But we then, I suppose, take it a bit of a step further. We want to know who runs these companies and how they've done it in the past. So that's what's their track record been of profitability maybe in the past, but it's also how they've treated the minority shareholder. And I think it's really important, particularly for small caps, as you get family members that are involved in these businesses. You get a lot of founders that are still involved today. So this was, somebody's brainchild. It's it's what they love, and they're still heavily involved today. That might be fine. We'd like to get to know who that person is, who's going to take over when that person steps down, and things like good corporate governance then become quite important to us. Now, we do call it North American Smallers. We could probably call it U.S. small cap. I would give you the example, the 40 Act fund, the U.S. mutual fund version of this, which looks the same. We do call U.S. small cap. We really are aiming here for largely U.S. smaller companies. We throw the North America in. We have historically had a few holdings within Canada. And so that exists still today. And I would say the amount probably hovers between kind of 2 and 8%, right? So fairly low exposure to Canada.
2 to 8% outside the U.S., you're saying?
Outside the U.S., yeah. And again, historically, that's been Canada. So even from that North American bucket, that kind of fits okay. I'll give you one area where perhaps we're a little bit different than some other funds. We do tend to have a very long-term investment horizon. And so, I'd give you the idea of kind of 3 to 5 years. When our investment managers and analysts research a company and come up with whether they think it's a good idea or not, we ask them to take more of a 3-year view. And so what it means is, I think among small cap managers, we're a bit lower turnover, at least from a name standpoint. So we're not about finding the next name today to put it in, to have it churn out of the portfolio in 3 months. So you tend to get probably a 2 to 3 year average holding period for most of our stocks. It's about a 50% turnover rate. I think you see most years as probably an average in the portfolio.
Okay. So Tom, obviously you guys are a bottom-up stock picking shop, but I'm sure you're not immune to sort of to the macro. How how are the portfolio managers right now currently positioned? Are they positioned for a slowdown in the U.S., perhaps a mild recession? Are they positioned for reacceleration and growth? The reason I ask you is because this year, as you well know, the S&P 500 index, basically about 7 names have had an outstanding year. The rest of stocks, though, have had a terrible year. If you look at the equal weighted index, I'm not sure with today's move, but as of a few days ago, there was about a 12% dispersion between the S&P market cap and the equal weighted index, where the equal weighted index was down over 2% for the year. The average New York Stock Exchange stock is down for the year. So talk about how you guys are positioned given that current environment, given that small caps already have been pretty beaten up throughout the year, right? So it has not been a strong year for the average stock, and definitely not for small cap stock. So maybe just a few words on that.
Yeah, sure. And it's certainly one of the differences I think you get with small caps compared to large caps. This goes whether you're looking at US or even globally in markets. You tend to not have those kind of big index weights. And so, oftentimes what's happening in the index can at times mirror what's happening even for an active manager, just because they tend to be pretty small weights at the top. You don't have the big drivers of some of these areas. And small caps, not having a great time right now is, I guess, the way I would say this, right? They actually had an okay start to the year. When you kind of go back and think about kind of maybe the first half of the year, you actually saw markets, but some decent absolute performance. But again, still lagging most of the large caps. So, although what I would say here is, if you remove those 7 kind of big stocks that are driving the market, I don't know if your absolute returns look that different. Maybe this past month, the small caps sold down a little bit more. We've seen now that even for some of these past years, listen, small caps had a tough time in 2022. And of course, this is, you feel that inflation creep in. You get the hike in interest rates. The smaller companies are going to have a more difficult time with that as a backdrop, right? These are smaller companies that perhaps don't get funding quite as easily, right? The smaller companies that you can't go to the debt markets the way some of these larger companies can. And you look at inflationary pressures, and some of these companies are very good at passing on inflationary costs, but sometimes you get these global businesses and perhaps they can shift some operations to some other countries where maybe they're not feeling it, right? So you would expect that they would feel it. But actually, if you were to go back now and look at probably, it's almost closer to the last decade, but I'll at least say the past 5 years, small caps in the US have really lagged their large cap peers, right? We're now seeing that one of the differential between the valuations of large cap stocks, and I caveat it a little bit because I agree it's some of these big names and large caps driving that, but you still look at what that valuation looks like in the discount that small caps are trading. It's one of the largest that we've seen in the past kind of 20 or 30 years. So I think from a positioning standpoint, I could sit here and say, hey, all the pain is priced in. I don't know if that's the case. It was a very difficult month of October for small caps, right? Just crossed into November here, but big sell down. And I realize other markets were struggling as well. I think small caps felt it a little bit more. I guess I would describe from a positioning standpoint, this should be a portfolio that probably weathers all a bit better than others. And historically, we've protected on the downside, right? There will be discrete periods. I'd give you the example, right? We fell more than the index last month. And, we had a more difficult 2022. But if you look longer term for us, we've protected on the downside. And so with that as an idea, what we're looking for here, stocks where we feel we have some earnings visibility. So it's less positioned for, we think rebounds around the corner tomorrow. And it's less positioned for, man, we're going to have a tough time. We're always a bit more, I'll call it defensively positioned, because we take that eye towards high quality stocks. So not with a ton of debt, right? So we're looking at a backdrop of rates probably higher for a bit longer. Our companies ought to do better with this as a longer term backdrop because they don't have to go back to the market and refinance. We like to find companies with strong defensible business models so they can pass on inflationary pressures. Maybe they have long-term sticky client relationships. We have some visibility forward on what their earnings might look like. And so that perhaps gives us, I think, some faith even if you told me, hey, we expect the U.S. economy to have a difficult time. Now, of course, what really has happened here is the U.S. economy has had a much better time, maybe than anybody expected. But we're now seeing, and listen, it's one day of a move today. We'll see what that looks like. But now all of a sudden you have maybe some kind of dovishness creeping in, right? Where the Fed is now suggesting, hey, maybe we're done hiking. I wouldn't profess to be able to sit here and tell you so. The expectations we have to a certain degree is that perhaps the US does tip into a recession, maybe a rather mild one in 2024. I think from our standpoint, we think a lot of that's been priced in. And small caps tend to really lead, cheating an outlook here, lead on the way out. So from a positioning standpoint for us, I think we've continued to take a look at, where are valuations trading really cheaply, but where we can find quality within that. So there's, probably a good 1/3 of the Russell 2000 index that very low returns, just not making profits. We stay away from those, right? So we're probably not playing in the absolute cheapest area of the index. One area that we have added to, which kind of cost us, if you look at 2022 for most of the year, was we've beefed up a little bit of our energy exposure within the portfolio. And I think it's the idea that there seems to be some good long-term drivers to keep the price of oil a bit higher for a bit longer. Mm-hmm. And so what started this year at one energy company, I think we're now up to 4 energy businesses. And it's almost taken us to kind of a neutral weight from that standpoint. We've been a little bit more cautious, I suppose, in some of our IT exposure. Now, IT was kind of a winning spot at times earlier this year. Had a very difficult 2022, right? If you're a growthier stock, you've sold off last year. We ultimately have seen that kind of hit us a little bit as we were in October as well. But we have some companies that we think play in some really good niches. They provide a really important service to their clients, but they perhaps don't cost their clients a whole lot. And so we have, still an overweight to IT, but we've probably see that as a narrower position than we've been in the past, which I think would suggest at least some defensiveness kind of into the portfolio as we move through this year.
Okay. So Tom, if you are, let's say, positioned in the quality space, quality factor, you would think that, you're in companies that have, higher return on equity, lower leverage, usually. Those have actually been performing relatively well this year. So what do you attribute to the underperformance this year of the strategy?
Yeah, it's been at times, and this will happen from time to time, some single stock kind of stories where there's been some difficulty. If we look through just the end of September, for instance, on kind of a gross basis, we were close to flat. By the time you bring the fees out, of course, underperforming. We had kind of a few stocks where we've had a little bit of a headwind with some of those business and what's been happening in those businesses. So in this case, for instance, a vision center that saw some contracts not renewed, to kind of give you the idea. Now, we've narrowed that underweight to energy, but we have seen a bit of a headwind from the fact that we've had an underweight to energy. And it's been a little bit, I think, of, yes, it's been better for quality this year, but I think as we moved through summer, we started to see a little bit of that reverse. And so actually, if you kind of looked at us, let's call it first 6 months of the year, was probably the state of kind of some slight outperformance, or at least flattish, even after fees. We wound up with a pretty difficult July and then a pretty difficult September. So kind of the third quarter as kind of where we felt that pain. And I think looking again squarely at September here, which was an underperforming month, even though some of those areas had done a bit better earlier in the year, we started to see some of those growthier exposures that we have sell off a little bit. And so, companies within the IT space, for instance, which, investors looking at, again, the prospect for rates being a bit higher for longer.
Mm-hmm. So Tom, over let's say a 10-year period, 5-year period, you guys outperform your benchmark by over 200 basis points from what I saw.
Yep.
Like you said, there's been a little bit of hiccups over the last, in 2022 and this year so far. Now, let me ask you this, because a lot of the pushback, because we know how cheap small caps are versus large caps on a valuation basis, if you go back throughout history, or especially over the last, 15, 20 years. But the pushback we always get from people is like, well, yes, but we've also been in a different rate environment over the last 15, 20 years. Now, this could be a different year. Are you of the belief that that valuation gap will close in favor of small caps, or are you of the belief that you need to try something different than what you've been doing over the past couple of years because we're in a different rate environment where rates will be systematically higher? They don't have to stay here,
Right.
but even if they go lower, unlikely that they go down to where they were before. And when they go up again, they'll probably go higher than where they are now. So we're probably going to be in an era of systematically higher rates. How do you make the case for small caps in that environment?
Yeah, so I think the way we look at it, and I think I would agree to a degree here, I don't think we go back. You may expect, some people may expect, the Fed kind of turns and pivots and we start to see some cuts. I don't think this era of kind of completely free money is normal and one that investors should think about. But I think small caps, listen, most companies kind of had roughly the last 10 years to kind of enjoy this really kind of era of free money. I don't know if it really the corporate mindset though, with regards to investing in businesses and trying to grow their companies. I think you saw I'll call it a bit of a reset from an investor standpoint, particularly on those growth stocks that had done so well. And it's hit the large caps too, because all of a sudden rates were up. I think if you see rates even a little bit higher for longer, I don't think that has to mean more pain for the small caps than it does for the large caps moving forward. I think if you were to start to see, now again, I don't know if we're going to hit soft landing here, or we don't know if the U.S. is going to tip into recession. I think if we get to a point where we stop talking about that anymore, so either the recession starts and it's brief, or it is kind of soft landing, the Fed is able to start bringing some rates down, the economy is doing okay, I think we move past that as maybe a bit of a headwind for this small cap asset class. And I think you start to see small caps come back quite sharply. And I think that's in part because of where the valuations sit today. Now, will the gap close? I don't think it has to, right? This doesn't have to be a story of complete mean reversion. I think the prospects for these small cap companies, despite even more, let's say 2 to 3% kind of interest rates, if that's the new normal, which obviously is still quite low, if you look over longer time frames, I think the prospects for small caps to earn money and to generate returns is still quite strong. And so I think you'll start to have investors eyeballing what those valuations look like. And I think small caps will still look really cheap. Now, I guess I would suggest, if you look over the really long time periods, right, they've traded at a premium to large caps. A premium historically was something like 7%. I don't know if it has to go back to that, right? But you're at this kind of 20+% differential of even getting there, right? There's a lot of room for small caps to make up. I think what maybe has changed on the large cap side a little bit, and again, this may come down to some of those big names we were hinting at before. You have some giant companies out there today, right, that are going to be bigger portions, presumably, for at least a period of time in these large cap indexes, probably are going to carry a higher valuation. So I don't know if large caps have to come back down and small caps have to pass again, right? That would be a great environment to hold something like this. But I think even if that just narrows, and I think there's a lot of scope to do that. This asset class, again, fairly underloved. So I think you actually have folks, because of the investment backdrop, probably less exposed to small caps. They've underperformed, and are folks adding into it? Maybe not. So I think you have, let's call it the prospects here for a U.S. soft landing or U.S. shorter recession. I think that gets priced in and folks start to look past it. I think now you see money moving into the small cap space. So I think with the valuation differential and some money moving in, it's a great backdrop for the asset class. Now, the other side of this that we've seen some evidence of, listen, it can help the strategy at times, but really it helps the small cap asset class, is a pickup in M&A activity. And these are smaller companies. If you have, and you start to have bigger or mid-sized companies starting to look for how they can generate growth, maybe at a time where the economy is not doing exactly what they want, or they can't borrow as much, maybe you start to see that some of these companies reach out a little bit and try to get some growth. So we've seen a pickup already, and this even started a little bit last year, kind of a pickup compared to years past of M&A activity. And it can help really drive and spur on returns of some of these businesses that we might hold. It's not a strategy, right? We don't look at a company and say, oh, let's buy this, hoping it gets taken over. But we've seen this nice pickup in M&A activity. I think that is really good, generally speaking, for the asset class.
Okay. And I'd like to remind everyone that if you do have questions for Tom, please submit them via the chat here. I'd be happy to read them out loud to him here in just a few minutes. If not, you can submit them to me directly as well. Tom, what's the team's, let's say, forward capital market expectations for the Russell 2000 over the next, 5 to 10 years?
Yeah, I would tell you that's a tougher one for the team and for me to kind of have an expectation here, right? We do really hold absolute return to be the most important, right? So we could talk about this large cap, small cap differential, right? That could narrow simply because large caps come off. That doesn't help you a whole lot if you're in these small caps. But I think if we look at, I don't know, potential earnings growth, and we start to think longer term for these businesses, right? I mean, you're a kind of probably a high single digit, mid-teens right now, with an expectation that probably increases next year. Now, that doesn't mean you're expecting that every year, but I think coming off low valuations, there's some scope here for some re-rating, and then a scope for these companies to perform well. So if you kind of told me on kind of an average annualized basis, coming from where we are now at a low point, that you were kind of a low teen type thing over these next 4 or 5 years as an annual return, I think that would be fantastic. I don't know if that's the case. I would give you anecdotally kind of two things that maybe give us some confidence that from where we are, and again, I'm not picking this as a low because I don't know, but from where we are now, what could be exciting about small caps and perhaps help generate that return that we're talking about. We have seen historically for small caps, when inflation is greater than 3% but is starting to decline, that the forward returns on the annual basis, on a 3-year basis, on a 5-year basis are really good. Now, they're really good for large caps, but in fact, they're exceptionally good for small caps. So so we've continued to see, and quite frankly, that's where we sit today, right? You have this inflation over 3 in the US, but we're starting to see that it's coming down a little bit. That is a tremendous, I think, positive. And then the other side of this would be if you're coming out of kind of a lower period now from a valuation standpoint, we've historically seen small caps do really well on the way forward, outpacing large caps typically as well. And so there's kind of a great potential that as we move forward, that there could be some strong absolute returns coming from the asset class.
Excellent. So Tom, this will be my final question before we open it up to the audience. Part of, I think, driving some of the outperformance, especially those Magnificent Seven, has been what I believe to be sort of an increasing sort of winner-take-all mentality, specifically with generative AI and other technologies running through the economy. So I think get an important question for investors, and perhaps you have some visibility about this, seeing as how you're seeing these companies up close. How have you seen the adoption and uptake of AI? Are the smaller companies also going to be able to benefit from some of the productivity and profitability enhancements that are coming from the technology? Or is this really just a winner take all and we're going to see large caps continue to outperform, right? What's your view?
Yeah. No, I think you could still have some large cap winners. I just don't think they're necessarily taking all. I think you'll see some of these trends really benefit potentially smaller companies. And I think it's in a few different ways and areas, right? So one is...
Yeah, maybe we can talk about some specific examples of some portfolio companies you have, if you have any.
Yeah. So I think one could be, and we'll kind of see how this goes, but kind of component businesses that are out there, right? I mean, you tend to think about the large cap, right? NVIDIA is the hottest name out there, right? Because this is this AI push. But I think there's perhaps a bit of a, I don't want to call it a forgotten element here of there's other companies that are making things that are supplying, and on top of supplying, but generating and in fact selling into some of these big giant businesses, right? From a standpoint portfolio wise, now this is, I wouldn't say we're set up because we think AI is going to happen, right? So we'll have, for things like, for instance, a number of software businesses. The example I would make here is some of these software businesses are going to be able to be perhaps more efficient as they're able to start to incorporate some of these, or if you're actually able to help clients start to incorporate things. And we tend to see that businesses we have one called Proficient. These are companies that come in and essentially try to solve issues that companies have. And if you're doing that and you're now able to help a company incorporate something, I think there's a tremendous, because I think we're at the early days, by the way, of some of this AI push and how companies will use this. We have two companies that fit kind of more in the semiconductor space, one called Kohu and one called Onto, O-N-T-O, Innovation. And I would give you the idea here, right? Onto has been one of our best performers on a year-to-date basis, right? So you have these companies that play into some of these broader themes. And they're, I'll call it caught up, right? They're kind of caught up in some of this as well. And that's my one caution with the AI. We think it is a real trend, but perhaps it's wider than AI, and it's this scope of just, think about anything you do today, right? It's the autonomous driving of the future. It's the interconnectivity of, your refrigerator or whatever it is that is smart in your home today. All of these things need the component parts going in. They all need the software, and then they need companies that are able to understand it. So I do think it's a winning game for these big companies that are really good at what they do. And even looking outside the US, right? This is long-term great for Taiwan Semiconductor, right? But it's also good for the smaller component players, whether they're in the US or not. So I think it's a real trend. I think it's a longer term game. I don't know if AI itself is the real trend, but this kind of interconnectivity of things is really important.
Excellent. Okay, great, Tom. So let's go a couple questions here. Some people are asking, what sort of sectors or companies are you currently overweighting or avoiding right now?
Yeah, so one of the key, I'll call it overweights that we've had, and it is not a big top-down view. It just happens to be kind of a catch-all sector, I suppose, for small caps, is industrials. And that sounds very cyclical, perhaps. I would give you the example that we're less cyclical than what we expect out of the index, and that means we want these steadier businesses. But I think what we find is that within industrials, there's some really interesting names of companies that do something that may not be as cyclical as you think, right? The example I'm going to use here is a business called Atcor. It's one of our largest holdings. They essentially go out and solve companies' problems of having energy connected to whatever it is they do, right? So it's the idea of, how do I get electricity to whatever it is that I'm going to do? And so from that standpoint, they've seen some extremely strong returns. They're kind of at the forefront of what they do and the technology that they provide. They just happen to fall under industrials. And again, that's not a top-down view that we should, I don't know, be looking at industrials, or industrials are fantastic, right? It just happens to be where we are. Consumer staples has grown a bit for us. When I think about kind of the exposure we have, it's about perhaps even weight today, but that's grown from where it is. But I'll give you the example of a business called Elf Beauty, which has been a great performer for us. I have a teen and a tween daughter at home, and skincare products and beauty products, particularly at affordable levels with really high quality.
Tween, by the way, I've never heard tween.
Oh, sorry.
In between teenager and okay, all right, okay.
Yeah, I don't know if it's a real term, but I've heard it that way. The other one's 13, so she fully qualifies. The other one's not there, but it's this big push. And so this company, Elf Beauty, has they've got some kind of mainstream stars that are pushing what they do now, but as a small cap stock, which we'll see if it lasts as one, it's done quite well for us. One of the areas that we've historically been pretty far underweight, we've made a concerted effort to try to narrow it, but we have some concerns at times with certain types of companies, is healthcare. And it's not for the lack of thinking that healthcare is not important, or seeing, of course, an aging population. It's the biotechs that tend to make up small caps, which give us a lot of pause. You get a lot of companies that are relying on one single drug, and it's really a question of, does that drug get approved by the FDA? Does it not get approved? And the stock will skyrocket in one direction or the other direction, right? It's a bit of a binary outcome that we've never been comfortable with. So we've tried to look for kind of the biotech companies that are either more established. We've invested in ones in the past that have kind of several avenues of growth, as opposed to just looking for the one that's all about one drug. But that's been the spot that's been kind of our biggest underweight. Now, the other one, and this could start to change as well now that rates maybe are normalizing a little bit, we've been underweight real estate. And when you think about real estate in the small cap world, it tends to be a lot of the real estate investment trusts, the REITs. There's a lot of leverage involved in these vehicles. We've at times been down to zero and not held any. We've at times, had some exposure. We've seen that that's probably come in a little bit, that underweight that we have, as we now do have a holding within that space. But we'll have to see as perhaps rates kind of normalize a little bit here, if there's anything that looks perhaps a bit more value.
I think it's notable that the best performing sector today is real estate. It's all the like interest rate sensitive sectors are doing well today. Yeah. So there's definitely been a sort of a recalibration here today.
Yeah.
All right, so let me go through a couple of questions because a few have come in.
Okay.
As far as liquidity is concerned, how do you go about selling large positions in the portfolio without affecting the stock prices too much?
Yeah, so we part of this goes into our low turnover approach. And so, listen, we have about 50 stocks. That would be an average weight of about 2%, but we do let conviction drive our weighting. So we will have holdings. We could go upwards of 5%. It's fairly rare. Our biggest holdings roughly today are closer to 3%. If a stock is that big in the portfolio, there's a lot of conviction that we have. It's probably one we've held for a period of time and built that up over time. I guess where I'm going with this is it is quite rare that we would have to take a position that large and exit it tomorrow. Now things happen. Things happen that you don't want to have happen. So traditionally, the way we do this, though, is to start slicing down a name over time. Now, if it's conviction, if it's valuation, if it's a view that a certain type of sector is having an issue and we're concerned that we're overweight, we're probably taking it down that's probably a 10 to 50 basis point move at a time, with the idea that we'd like to have that at a lower weight. So when we've tended to exit in the past, we're probably closer to 1.5% when we're ready to make that decision. And so we haven't had an issue from a liquidity standpoint. The market, despite having a tough time these last couple of years, it's surprisingly perhaps big and liquid and rather heavily traded. There's going to be some names which don't have quite the liquidity that we have in other names, and we've tended to probably keep them at lower weights as more of a risk tool to say, hey, we're not probably going to increase this size too much because perhaps liquidity is a bit of an issue. So we tend to try to be sensitive about that. We're not looking to affect the price, but it's quite rare. I mean, I can't think of a time where we've probably had a greater than 2% position that we've had to say, hey, we have to exit this tomorrow.
Understood. Okay. Do you agree with focusing on companies with near-term cash flows over those with only terminal value?
Yeah, we really like cash flows. We want companies with earnings, and we want companies that have cash coming in, right? So we'll have a greater priority there than just the idea of whatever this company does. They're not earning anything today, but maybe they've got the next best idea for tomorrow. Is probably one that feels a little risky to us. So we certainly play in that area of what do your cash flows look like? How predictable are those cash flows coming through? And do we have faith, to the extent that you can have it, that we're going to see those kind of year in and year out, right? And a lot of that will go towards building or perhaps detracting from the conviction we have in a name.
Okay. And then final question, Tom, are take privates good for you and for the small cap space?
So if we have a company and they're getting taken private?
Yeah.
I guess it depends. The general answer is if we see companies in the portfolio taken out for some reason, either another company's coming in to buy them, right? We had Hostess brands. So if you grew up certainly in the generation I did, Twinkies were huge. had Hostess brands, and there's a giant company, they make things like jelly called Smucker's, taking Hostess out, right? They're taking them out at a premium. So that's great. On the take private side, it's probably not as clear cut. I'm kind of thinking back. I don't think we've had kind of any recent examples there. You sometimes we would rather consider that business is a good long-term holding and going to be cash generative and compounding over time. And sometimes when you get the take private, the deal is not quite what you're looking for. In fact, sometimes it's some certain shareholders that have certain types of shares that are probably going to benefit from that, which probably isn't us, the minority shareholders. So we're a little cautious there. We do really like, well, I'll caution that. We don't love when our companies get taken out. It usually has a good effect on the portfolio when they get taken out. The PMs would say they don't love it because that's a business they've put a lot of time and energy in, and now they have to go find a new one. So,
right. Excellent. Well, Tom, thank you so much for your time. Really appreciate you. Definitely make sure that everyone checks out if you're interested in the strategies. It's the Aberdeen North American Smaller Companies Fund. It's had a track record since 2011, from what I can tell.
Yep.
And as I mentioned earlier, over 200 basis points of overperformance over the Russell 2000 since inception. So, Tom, appreciate your time. Thank you for joining us. Hopefully, we can do this again.
Great. I certainly appreciate it. Thanks, everybody, for joining.
Thank you. Take care.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.